we're going to take a look at investor behavior, try to find out what drives investors to make so many mistakes. Meir Statman is the professor of finance at Santa Clara University's business school. He is also the author of the book entitled What Investors Really Want. Well, they really want profits, but maybe not. Also, we have Dennis Hynes, chief market strategist at RW Pressprich, to lend us some technical expertise. Gentlemen, great to have you with us on Taking Stock. Meir, let me begin by posing to you the notion that The Inside Job, which is the documentary about the financial crisis, won Best Oscar for documentary filmmaking last night at the Oscars. Now, if you take a look at Inside Job, you meet a lot of people that are supposed to be very smart. Some people say, well, we saw this coming. Others say, well, we never saw this coming. What is a regular investor supposed to make of something like that? Because after the effect, after the shock, it seems like everybody was brilliant. But at the time, it was pretty hard to find people. Maybe John Paulson is the exception, but it seems as though it was difficult to find people who were pointing the finger and saying, this is going to end badly.
That is right. A few people did. But I think that after the fact, we are left with that illusion that it is easy to see what was coming, because a few people did. And it gives us the confidence, the false confidence, that we can tell the future as well as we can tell the past. And that is really very dangerous, because it leads investors to jump in and jump out because they have some sense that the world is going to develop one way or the other. And more often than not, it does not.
Why is that? Is that because there is something that we are hardwired to always get wrong? I mean, was there any idea that as cavemen we always knew we were going to pick the wrong stock to invest in?
No, I don't think so. I think that caveman was designed reasonably well. I think that the idea of hindsight is that we look back at our own actions and we learn from them. And so if we have, say, wronged a friend, then we see the consequences, then we learn not to do that again. The problem really is that when we take it to areas that were far from what the caveman was doing, like the stock market, and the stock market has this tendency to go wherever it wants to go and just fool us and frustrate us forever and ever.
Dennis Hynes, come in on this topic, because I have a colleague who once told me that stock prices have no memory. The only thing that has a memory is an investor. And you use charts to really try to understand what it is that buyers and sellers are doing in a marketplace. There's nothing more about it. It's about an expression of activity. What do you make of Meir's thoughts having to do with people looking in the past and then in the future?
Meir's comment is very apropos. The truth is, I'm a market timer, but I don't believe that you can forecast future direction of prices. At the same time, getting back to the 2007, 2008, there was really nothing that you could have said that affected policy. As you say, there were one or two people in front of it. Most people were not. The way I approach the market is the same way I approached what happened in 2007, is I monitor the market for continuation and change. When we got to the October 2007 record high or highs, things started to sell off. All of a sudden, we knew something was going on. The icing on the cake was when a venerable firm, really street tough firm, Bear Stearns, went out. Something was bad in the state of Denmark. And so those were the continuation and change. The change taking place was that good firms are going out of business.
But if that's the case, don't you need to know that much sooner than the actual event? I mean, you need to know that there's going to be a crash before there's a crash to make any of this worthwhile.
It depends upon how aggressive you are. If you are, there are two ways to deal with this. One is, as a timer, that you can use something as simple as a momentum system, something as simple as a 50-day moving average. Had you used a 50-day moving average on the S&P 500, you would have gotten out of your longs right near the top. Even if you waited for it to pierce the longer-term 200-day moving average, you still would have saved oodles and boodles of money. So the question is these momentum, simple trend lines. If you were to draw a simple trend line in the crudest way, it would have told you that markets were going south, no longer sustaining longer, higher prices.
What about this idea of using some of these tools, but then isn't there the question of matching the tools to the user? Because not everyone knows how to use a hammer or a saw. Not everyone can build a table. So maybe these tools are in the wrong hands sometimes.
Well, the question is about the tools themselves first. Now, there is such a thing as momentum, of course. But what we need to do is apply the tools of science first and foremost, and really check whether those patterns of reversals and continuation indeed work. In other words, it might be that you'll have a signal to get out of the market. And as soon as you get out, the market goes up.
Dennis, we were talking during the break a little bit about discipline and how important discipline is. And we were kind of getting into it a little bit, but then I said, I know something about you. You are an expert in karate. And that is something that has got to focus your mind in terms of discipline, practice, consistency, and also self-critique, self-criticism. Are those the kinds of things you think that are connected to why you're so disciplined when it comes to the market?
I think it certainly adds to it. But I was trained early on as a computer programmer, which in fact also adds a layer of discipline. My life for a very long time was essentially a combination of if-then statements. If this happens, then I do this. And I think if you take that approach, you can come up with an objective set of rules which will allow you, when you see the same conditions showing again and again, that you can act consistently.
Meir, what about that? Because you were saying, you're trained as a scientist, and that has given you a little bit of an insight into how people make decisions and indeed maybe how they shouldn't make them.
Precisely. So I think through that, what is it that we know from systematic studies rather than how I feel about it? And so I know from systematic studies that most investors who try to beat the market end up beaten by the market. And so I don't try to do that because I know it is stupid.
Well, when you get inside someone's brain, let's say they've made money on a particular trade, there's no way to know whether that was dumb luck or whether they nailed it and that was the right company because of all the reasons that they originally gave themselves. Does that stimulate some kind of chemical in the brain that makes them feel that the next time they're going to be even better at this?
Sure. I mean, this is natural. This is how we learn. If we do something and it works, then we say, aha, we got it. The problem really is that when you have luck and skill, and where luck predominates, as it does in investments, then people give themselves credit for luck, and then they go on, and next time luck doesn't work in their favor, and that's too bad.
One of the things I know you want to discuss a little bit is this investing phenomenon in social media sites, particularly Facebook. $50 billion, $52 billion valuation. You get to join the club if you're a private investor. You get to feel very lucky if you can spend some of your money to buy into Facebook. Is that something that tells you a little bit about how investors should not operate?
Well, if you have $100 million and Goldman asks you to put perhaps $2 million on Facebook, I mean, you can lose it and still you'll be fine. So
or make a lot of money and still be even finer.
A lot of money, exactly. But it's not. I would not advise them not to do it. They can play with the money because they have plenty of it. But you can see that people who have $100 million are no longer thinking about money for use as the rest of us do. They think about it as a status symbol. And just being invited to be a member of this inner club of being offered shares of Facebook tells you you're one of the chosen. Surely feels good.
Makes you feel good. Dennis Hynes, does it make you feel good if you set aside a small amount of money in the portfolio to test your brain, see how good you really are at active management, picking stocks, while you've, in a sense, tied your hands down and said, all right, the money I really need, I got to be much more careful about that. I have to be disciplined about how I allocate that.
Makes perfect sense. It takes care of some of the things that the professor was talking about, whether people are making stupid bets or let's say ill-defined bets. But the fact is that, yes, do take some money, set it aside, practice, experiment, and what you can do is you will develop a skill that you may be able to migrate over to the larger portion of the portfolio.
Do you think that using that as a sort of stepping stone is a way that people can learn to get even better, or does the larger amount of money then have an even greater influence on making the decisions? Because if it's more money, it's more risk.
The larger amount of money should be set aside on what we would consider to be acceptable asset allocation methodologies with rebalancing. And if you do that with a thoroughly diversified portfolio, including cash, including gold, real estate, and other commodities, with equities, domestic and foreign, that lion's share of your wealth will be protected. However, if you want to go for the home run, such as the next high tech, the next Facebook, okay, that's the ones that you're looking for, then yes, the way to do that is to experiment with the methodology which helps you identify those early on their career.
Meir Statman,
give
you 30 seconds here. Go ahead.
Very careful, because the $20 million in your play account, you will make some money off them. You will think that you're a genius. Now you're going to play with your retirement fund and you're going to lose it. So I would advise people to keep those mental accounts separate. There is serious money and there is play money. Don't learn from
You're agreeing.
You're
responding. I'm going to give you 3 seconds.
I'm responding yes and no. The side money, the big money, was already set up in a diversified allocation account.
All right, we got to leave it there.